Imagine a countdown, not for a celebration, but for a financial catastrophe. Picture the anticipation, the ticking seconds, each moment bringing us closer to an unforeseen disaster. Envision the world on the brink of economic chaos, unaware of the storm brewing in the financial markets. This was the reality in 1987, on a day now etched in history as Black Monday. This is the story of Black Monday, a day that shook the world's financial systems to their core. The year was 1987, a time of economic prosperity and investor optimism. The world was reveling in a period of robust growth and buoyant markets. The stock market, particularly in the United States, was on an upward trajectory, with Wall Street enjoying a bullish trend that seemed unstoppable. Investors, both seasoned and novice, were riding high on this wave of prosperity, their optimism fueled by the seemingly invincible market trends. The finance world was buzzing, filled with a sense of invincibility. This was a time when the economy was booming, businesses were thriving, and the stock market was breaking record after record. The Dow Jones Industrial Average, a key barometer of market health, had more than tripled in less than 5 years. Investors all across the globe were pouring money into stocks, lured by the promise of high returns. Yet, despite the rosy exterior, not everything was as it seemed. The market, for all its vibrancy and dynamism, was showing subtle signs of overextension. Economists and market analysts started noticing that the rapid growth might not be sustainable. There were whispers of a potential bubble in the market, and some even dared to suggest that a crash was imminent. But these voices of caution were drowned out by the overwhelming optimism. The general consensus was that the market was simply too strong to fail. But beneath this facade of prosperity, a storm was brewing. October 19, 1987, a day that would go down in history as Black Monday. The sun rose that day, casting a harsh light on a world in turmoil. The stock market, that invisible pulse of global economics, was about to go into cardiac arrest. The bullish market trends and investor optimism that had so recently buoyed the world's economy were about to take a catastrophic hit. The numbers began to tumble. In the United States, the Dow Jones Industrial Average fell by a staggering 22.6%. This was the largest one-day percentage drop in history, but the shockwave didn't stop there. This financial earthquake rippled across the globe, shaking the foundations of markets in Hong Kong, Australia, Spain, the United Kingdom, and Canada. In Hong Kong, the market fell by 45.8% in a matter of days. Australia's market dropped by 41.8%, while Spain's plummeted by 31%. The United Kingdom and Canada weren't spared either, with their markets dropping by 26.4% and 22.5% respectively. This was not just a crash. It was a global financial meltdown, a tsunami of uncertainty that swept across the world, leaving no shore untouched. The financial world had seen crashes before, but never on this scale, never with this level of interconnected devastation. Every tick of the clock, every flash of the ticker tape spelled disaster. Investors watched in disbelief as their fortunes vanished into thin air. Confidence evaporated. Trust in the system crumbled. The once bustling trading floors were now scenes of chaos, the air thick with panic and desperation. And yet, amidst the chaos, there was a strange sense of unity, a shared experience of shock and bewilderment. The world had collectively held its breath, waiting for the crash to bottom out, for the dust to settle. In one day, the global financial landscape was changed forever. As the dust settled, the world was left in a state of shock and confusion. What had seemed like just another Monday had turned into a day of financial turmoil, a day that would go down in history as Black Monday. The stock market crash had left a profound impact on financial markets worldwide. The bullish optimism that had ruled the roost was replaced by a bearish pessimism. Investors, both big and small, were left reeling, their dreams of financial prosperity shattered in a single day. Global markets plunged into chaos. Trading floors, once bustling with activity, were now scenes of panic and disbelief. The ticker tape, once a beacon of prosperity, now read like an obituary of financial dreams. The Wall Street bull, the symbol of aggressive financial optimism and prosperity, seemed to have lost its fight. The public reaction was one of shock and dismay. The crash was not just a financial crisis, it was a social crisis. It was a crisis of confidence, a crisis of belief. People had trusted the system, invested their hard-earned money, and in a matter of hours, they saw their investments evaporate. The dream of financial security seemed more like a mirage, Investors from Wall Street to Main Street were left grappling with the reality of their losses. The dream of a secure financial future seemed to have been ripped away from them. For many, it was not just about the money, it was about the trust they had placed in the system, a system that had let them down. The media was awash with stories of financial ruin. Headlines screamed of the biggest one-day stock market fall in history. The financial world had experienced a seismic shift, and the aftershocks were just beginning to be felt. But amidst the chaos and confusion, there was also a resolve to pick up the pieces, to rebuild, to learn from the mistakes of the past. As the world grappled with the aftermath of Black Monday, one thing was clear: the world of finance would never be the same again. The world had witnessed a financial earthquake, and the aftershocks were yet to come. In the face of crisis, governments and financial institutions scrambled to restore order. As the world grappled with the financial chaos of Black Monday, a collective response was needed to halt the freefall of the markets. In the United States, the Federal Reserve stepped in swiftly. They flooded the market with liquidity, assuring the financial institutions that they would serve as a source of funds. The goal? To keep the financial system from collapsing. Across the Atlantic, similar actions were taken. The Bank of England extended significant loans to financial institutions, while the European Central Bank increased market liquidity. Simultaneously, governments around the world were taking action. They were implementing policy changes to prevent a recurrence of such a devastating crash. Rules were instituted that would halt trading if the market fell too quickly in a single day. These circuit breakers, as they came to be known, are still in use today. In the midst of the turmoil, financial institutions also had to adapt. They began developing more sophisticated risk management tools, focusing on portfolio diversification and stress testing. This collective response was a testament to the resilience and adaptability of the financial system. The actions taken in the aftermath of Black Monday were not just about damage control. They were about learning, adapting, and preparing for the future. The emergency measures taken would shape financial policies for years to come. Black Monday left a lasting imprint on the world of finance. It was a day that shook the very foundations of economic systems, leading to significant changes that continue to impact us today. The crash prompted a reevaluation of financial regulations, which had been largely unprepared for such a calamity. New rules were instated to offer better protection to investors and prevent a similar catastrophe from happening in the future. These include the implementation of circuit breakers, mechanisms designed to halt trading temporarily during significant market drops, to prevent panic selling. In addition to regulatory changes, Black Monday also brought about a shift in trading mechanisms. The crash underscored the need for more advanced and reliable technology to manage the fast-paced world of stock trading. As a result, we saw a move towards electronic trading systems that could handle high volumes of transactions more efficiently and transparently. But perhaps the most profound impact of Black Monday was on investor psychology. The crash served as a stark reminder of the inherent risks of the stock market. It led to a more cautious approach to investing, with an increased emphasis on risk management and diversification. There's no denying that the events of that fateful day in October 1987 transformed the world of finance. The crash of the '87 was a harsh lesson in the fragility of financial systems. Black Monday, a day of financial chaos, brought with it valuable lessons. We learned, in the most dramatic way, the fragility of our financial systems. We saw how global interconnectedness can trigger a worldwide domino effect, causing markets around the globe to plummet almost simultaneously. We learned the importance of having robust financial regulations in place, as the lack of such regulations was a contributing factor to the severity of the crash. The necessity of efficient trading mechanisms was also underscored, as the existing ones were overwhelmed by the sheer volume of transactions. Moreover, we were reminded of the psychology of investing. Panic and herd mentality can drive market trends as much as rational decision-making. Investor confidence, once shattered, takes time to rebuild. Lastly, Black Monday served as a wake-up call for governments and financial institutions, prompting them to devise strategies for crisis mitigation and prevention. Are we prepared for the next financial storm? Only time will tell.